Maintaining a rules-based approach to buying and selling stocks is key to successful investing. We must keep our impulses in check and make calculated decisions to give ourselves an edge. Some of the most important rules that you must honor are your buying rules. They clue you into whether it's the right time to buy a given stock or not. Having buy rules is one of the best risk management hacks out there. As a quick overview, the best time to buy a stock is when it's clearing a proper entry point. After a stock has established a floor of support and builds the right side of a chart pattern, it will eventually run into a new ceiling of resistance. That becomes a testing ground for the stock. Will the stock bump its head against that ceiling and fall back down, or will it punch through that ceiling in big volume and break out to new highs? That line of resistance establishes the ideal buy point. If the stock has the power to punch through the ceiling in strong volume and market trends are favorable, chances are high that the stock is ready for a new run. These base patterns include the cup with handle, the double bottom, flat base, base on base, and ascending base, to name a few. Now, once the stock has moved far enough past that buy point, it's no longer a good idea to buy it. This is because the stock is now extended from the buy point. However, there are exceptions to this. Sometimes a stock can form an alternate buy point before it even breaks out of one of the standard chart patterns. Other times, a stock may form an additional buy point after it clears a proper base. These are key to pay attention to because they allow you to build up a position in a stock over time and ensure that you're always buying at optimal points along the way. Almost every chart will eventually give you alternate buy points. These can take the form of downward sloping trend lines, 3 weeks tight entries, and more. We're going to review some of these, starting with the 3 weeks tight. First, you'll likely see the stock rally 5%, 10%, or more from its proper buy point, then refuse to give up ground. From here, if shares close at nearly the same price for multiple weeks in a row, you're probably seeing a 3 weeks tight form. This tight trading action suggests overall demand for the stock is very high. If the difference between each weekly close exceeds 1.5%, the 3 weeks tight pattern likely has flaws. But if the difference between each weekly close is less than 1.5%, then you can use the highest point in that cluster as your entry and buy the stock as it moves above it. Once a stock is more than 3% above the high of the 3 weeks tight, it's considered extended. One more thing to note is that some 3 weeks tight patterns stretch into a 4 weeks tight pattern. Whether it's 3 or 4 weeks, the same principles apply. Next, there's the short stroke pattern. It's quite an unusual pattern and it forms over just 2 weeks. The first week is marked by a strong advance of 10% to 20% or even more, and usually comes shortly after a breakout from a base pattern. The second week will show tight trading. The difference between the stock's weekly high and low will typically be just a few percentage points. Investors should watch for the stock to rise or fall just slightly in the second week without making a new high. This tame action after a big run up shows that institutional investors are in no hurry to sell. Then, if the stock clears the high from the big up week after going nice and tight for a week, then that would mean that the stock has cleared a short stroke entry. See this BlackBerry chart from the early 2000s as a very good example. Another alternative entry is the shelf pattern, which is a small area of consolidation that happens between bases. There's no set maximum depth for a shelf, but most will show declines of well under 10%. It's less about the exact depth and more about seeing a reduction in volatility from the prior base. A proper shelf should give a feeling of calmness, where the bulls and bears are having a moment of truce. A short 5-day shelf should be very tight. In contrast, a 4-week shelf might have a small shakeout or two. But we need to see at least one clear area of resistance. This might be the high of the shelf. Most of the time, you'll see a downward sloping trend line within the shelf for an earlier entry as well. Longer shelf patterns tend to have multiple resistance areas. When a stock breaks above a resistance area in a shelf pattern, the expectation is for it to move higher, but don't necessarily expect the same huge move you would likely see out of a base breakout. The next early entry is one we just mentioned, the downward sloping trend line. This is perhaps the simplest to demonstrate visually. Downward sloping trend lines can be found by connecting a stock's recent highs and can also yield actionable buy points that are often earlier than the buy points in the classic base. When a stock breaks out over a trend line, in many cases, it's also breaking out of a downtrend. In some cases, stocks breaking out of downtrends will be far off highs, as opposed to stocks building bases in an established uptrend which tend to be closer to new high ground. Trend lines can be drawn on daily or weekly charts. The best trend lines on a daily chart are found when at least a few highs can be connected over a time frame of at least several months. For shorter-term traders like swing traders, these potentially actionable trend lines could appear over a period of a few weeks or even days. Finally, the last alternative buy point we'll be looking at is the pullback to a moving average, such as the 10-week line on a weekly chart or the 50-day line on a daily chart. After a stock breaks out from a buy point, it will eventually consolidate again and may even pull back to find support at a key level such as a moving average. So what is support? Well, institutional investors often use the 50-day or 10-week line as a reference point, stepping in here to add shares to their positions when a stock pulls back to that moving average. This buying creates upward pressure or price support to help keep the stock's prices above that moving average. This is why rising stocks often rebound from their 50-day lines, turning brief pullbacks into follow-on buying opportunities. These opportunities can be especially powerful when the rebound takes the form of an upside reversal, shaking out weak shareholders and closing the day or week high up in that trading range. On the other hand, a rallying stock that undercuts its 50-day moving average in heavy volume is often sending a sell signal. Once a stock is decisively below this line, it typically signals the stock at the very least needs time to build a new base. It can also signal the end of a stock's move. All investors should learn how to buy using alternative entries. Some key things to remember are, if you're using an alternative entry as an add-on buy point to an existing position, the follow-up buy should only be a fraction of the full size position, such as 1/8 or a quarter. Your level of conviction in the current market environment, as well as the individual stock, will help you decide how much exactly to add. The reason add-on buys should be smaller is because if you buy the same number of shares as the initial buy, your average cost will go up by a lot. This leaves you more vulnerable to a loss if the stock pulls back to its traditional buy point. This portfolio management strategy, also known as pyramiding, is a smart way to invest, as you're only putting more money to work after a stock has proven that it can go higher. What you are essentially doing is averaging up, the opposite of averaging down. The latter is often a losing proposition. Some traders will often use these alternative buy points to initiate a position. Just remember that alternative entries, like any other type of entry point, can fail, and like any buy point, it is key to have a stop loss in place before you buy, since risk management is paramount. So remember, use alternative entries in your investing to grow your existing positions and take advantage of less obvious entry points along a stock's run higher.